Hello and welcome back to Global Value. In today's video, we are going to be performing a fundamental stock analysis of Lowe's Companies, Inc., ticker symbol LOW. Lowe's is the second largest home improvement store in the United States. It's also a Dividend King. It's been paying out an increasing dividend annually for the past 59 years, putting it in select company with only a handful of other publicly listed businesses. Specifically, Dividend Kings are companies in the S&P 500 that have paid out increasing dividends for each of the past 50 years. Again, Lowe's has paid out increasing dividends for each of the past 59 years. Lowe's is also the largest position in Pershing Square Capital Management, which is run by Bill Ackman. Currently, Bill Ackman's fund owns about 1.5% of the company. In their 13F filing, which include American-listed businesses, it makes up 20% of their American-listed public stock portfolio. So at the time of recording this video, Lowe's is trading for $199.08 per share. Year to date, their stock price is down 23%. However, over the past year, their stock price is actually up 5%. Over the past 5 years, Lowe's stock price is up at a rate of about 20% compounded annually. Over 10 years, they're up 22% compounded annually. And over the past 17 and a half years, going back prior to the global financial crisis, Lowe's stock price is up about 11.5% compounded annually. And keep in mind that this is not including the dividends that the company pays out. Lowe's currently pays out about a 2.1% dividend yield. So Lowe's is trading in between their 52-week high and low. They're a little closer to their 52-week low at this point. They have about 1.5% of their shares outstanding sold short, and Lowe's is a large business. They have a $127 billion market cap. For some more background about the business, Lowe's is the second largest home improvement retailer in the world, behind Home Depot, operating 1,971 stores and servicing 230 dealer-owned stores throughout the United States and Canada. The firm's stores offers products and services for home decorating, maintenance, repair, and remodeling. Lowe's targets retail, do-it-yourself, and do-it-for-me customers, as well as commercial business clients. Lowe's captures a low double-digit share of the $900 billion domestic home improvement market based on Lowe's estimates for market size. So the company also sells its products through its website, including Lowes.com and LowesForPros.com. Lowe's Company, Inc. was founded in 1921 and is based in Mooresville, North Carolina. So today's fundamental analysis is going to be a modified version of the 8-pillar analysis popularized by Everything Money, taking a look at 8 key financial metrics of Lowe's as a company to come to a holistic and beginning understanding of Lowe's based on their fundamentals. So let's get right into our analysis. Starting off with pillar number 1, we want their average PE over the past 5 years to be below 22.5. Currently, Lowe's is trading at a 16 PE. Over this time frame, they've gone to a high of trading at 41 times earnings and a low of trading at 12 times earnings. Averaged out, they're trading at a PE of 24, so this is going to be slightly above that metric we're looking for. Not horribly off here, however, this is still going to be an X to start off on pillar number 1. Next up, for pillar number 2, we want their average 5-year return on capital to be above 9%. Over the long run, over the course of decades, a stock is going to return approximately what its underlying business returns, and those underlying business returns are going to be captured here by return on capital. Lowe's does a great job earning above average returns on capital in each of the past 5 years. They've steadily increased their return on capital since the pandemic, and they're averaging a return on capital of about 33.5% each year. So this is going to be our first check here on pillar number 2. Their returns on capital are nearly 3 to 4 times that 9% metric we were looking for. So Lowe's is able to generate significantly above average returns on capital. Next up, pillar number 3, we're looking for 5-year revenue growth. Lowe's has grown revenues from $68.5 billion in 2018 all the way to $96 billion as of the beginning of this year. So while some of this is due to higher input costs that are just going to be passed along to consumers, Lowe's has managed to produce stable and steady revenue growths over this time frame. Revenue growths approaching 50% over these 5 years. So that is going to be another check on pillar number 3. Pillar number 4, we're looking for 5-year net income growth. Lowe's has grown net incomes from $3.4 billion in 2018 up to about $8.4 billion in 2022. So they've more than doubled net incomes over this time frame. That's another check here. Pillar number 5, we're looking for decreasing shares outstanding. When you purchase a share of stock, what you're really buying is a fractional ownership percentage in that underlying business. When a company buys back shares and decreases the amount of stock that they have outstanding, they're increasing existing shareholders' ownership percentage of the business and ultimately increasing the percentage of profits that that shareholder is going to be entitled to without the shareholder having to spend a dime. So we want businesses that are buying back stock when their shares are reasonably priced. Here, Lowe's has decreased their shares outstanding from 840 million in 2018 down to 699 million in 2022. So in the past 5 years, Lowe's has bought back about 17% of their shares outstanding. That is a huge number here, and in such a strong business that's earning such high returns on capital, that's absolutely phenomenal for long-term shareholders. If you had been a shareholder over this time frame, you now own about a fifth more of the company than you did at the start of it. This is a huge check on pillar number 5 and a great sign to see here. So far through 5 pillars, we've got 4 checks. Let's keep it going. Next up, pillar number 6, we're looking for 5-year free cash flow growth. So free cash flow is cash from operations minus capital expenditures. It's this column here in green. Free cash flow is the lifeblood of any business, and a business's abilities to produce free cash flows now and until Judgment Day, discounted back by some reasonable interest rate, is ultimately what that business is going to be worth. A business can use free cash flows to pay dividends, buy back shares, pay down debt, make acquisitions, or reinvest back into the business. So in 2018, Lowe's produced $3.9 billion of free cash flow, and that has grown to nearly $8.3 billion of free cash flow in 2022. So we can see that after taking a hit in 2020, Lowe's has been able to rebound quite strongly, and they've nearly doubled their cash from operations while pretty much spending the same on capital expenditures over this time frame, resulting in a significant increase in free cash flows. So the pandemic, while initially hurting Lowe's, actually has bolstered them quite a bit. So their free cash flow has more than doubled over this time frame, and in an average year, Lowe's is producing about $5.8 billion of free cash flow. Next up, for pillar number 7, we want their net debt, which is long and short-term liabilities minus cash and short-term cash equivalents, to be below their average 5-year free cash flow multiplied by 5. This will help us determine whether the business is excessively levered or not. We don't want to be investing into businesses that are using excess leverage. So Lowe's case, at the beginning of this year, they had $28 billion of net debt. And when we multiply their average 5-year free cash flow of $5.8 billion times 5, that brings us to $29 billion. So this is going to be a check here on pillar number 7. If Lowe's keeps producing average years of free cash flow over the next 5 years into the future, they'll have more than enough money to pay off all this debt. Another thing to note about Lowe's is because they're retail, a lot of this debt is either going to be lease obligations or potentially mortgages. I'm not sure if the business leases their locations or owns them. That's something that's worth learning more about. It would also be worth learning if they lease their buildings, when these leases would potentially be renewing, as that could increase their expenses and potentially their debt. So again, this is a check here on pillar number 7. So far through 7 pillars, we've got 6 checks. Then finally, the big pillar of them all, pillar number 8, we want Lowe's market cap to be below their average 5-year free cash flow multiplied by 20 to give us a reasonable starting point as to a valuation for the business. So currently, Lowe's has a $127 billion market cap. When we multiply their average 5-year free cash flow of $5.8 billion times 20, that only brings us to $116 billion. So this is going to be an X here on pillar number 8. And just because we're off here on their valuation does not mean that we're going to throw out Lowe's entirely as a business. This type of analysis is a holistic and beginning understanding of Lowe's as a business to determine whether it's worth your while to do further due diligence. No pillar should really be taken in isolation, and we should really consider Lowe's as a business holistically. So because of all those other holistic factors that point to Lowe's being a very strong business, it might be worth it here to give a higher valuation multiple to Lowe's, although that's something that you'll want to continually learn about. And the way to do that would be to dive into their 10Ks and read through their annual reports and their earnings transcripts to learn more about the business, understand exactly how their debt is structured, what management is projecting for the business, and how management is approaching capital allocation. So potentially, even though we're off here, Lowe's might justify a bit of that higher valuation, but we're only going to be able to determine that through further research. Then, as noted, Lowe's is a dividend king. They've increased their dividend payouts for each of the past 59 years. So here we're looking at Lowe's dividend profile. Investors can make mistakes all the time by blindly chasing dividend yield. So it's very important to look at a business's dividends to see if they're sustainable and supported by that business's abilities to produce free cash flows. In the case of Lowe's, they're able to produce a ton of free cash flow per share that's able to support this increasing dividend. So their roughest year came in 2020, but since then they have basically been gushing free cash flows, and they've been paying out less than a 25% dividend payout ratio. They have plenty of room built in to keep paying out an increasing dividend amount. So this is an excellent sign to see, especially if you intend to potentially be a long-term shareholder in Lowe's going into the future. And between the increasing dividend payout and the large amount of recent buybacks, management has been returning a lot of capital to shareholders. Then finally, here we're looking at a discounted cash flow analysis for Lowe's. In this model, we're taking last year's most recent cash flows. Then we're using a growth number based on Lowe's historical averages since 1990. Over this time frame, Lowe's has grown free cash flows at about 15% annually. It's very important to note that Lowe's is at a significant all-time high for their cash flows, so this might not be as reasonable as it first suggests. But if we take that 15% growth rate for the next 10 years, which is again already growing from a historically high base, and then we take a terminal stage of growth over the next 20 years where we assume that Lowe's only grows at 4% a year, when we add in their tangible book value, which is currently negative, we get a fair value for the business that's about $214 per share. And if you would purchase the business right now and you assumed that this historical trend in free cash flow growth is going to continue now into the future, you can expect about a 13% compounded annual return over the next 30 years from Lowe's. Again, this is coming from a historically high base, so this is probably not realistic, but this is what their historical numbers would suggest. Let's say we cut that historical growth rate down in half to 7% for the next 10 years and keep our terminal value the same. Then that would suggest that Lowe's has a fair value of about $211 per share, and you could reasonably expect about an 8% compounded annual return. Keep in mind that this return is going to be including their dividend payouts, so dividends are not going to be double counted for this return. So again, this is just a starting point based on their historical numbers. This is not financial advice, and this is no buy or sell recommendation of Lowe's. If you believe these assumptions, then please go out and do further due diligence, consult with the proper financial experts and professional advisors, and ultimately do your homework and learn more about the business before considering any sort of financial investment. So in summary, Lowe's checks the box on 6 out of 8 pillars. They're currently off on our valuation metrics, but as we've seen, the overall quality of the business may justify a higher multiple there. Lowe's earns about 33.5% returns on capital. They've seen nearly 50% revenue growth. They've seen their net incomes and free cash flows more than double over this time frame. They've bought back about 17% of their shares outstanding. They're not using excess leverage in their business, and they've got plenty of room based on their abilities to produce free cash flows to keep increasing their dividend well into the future. As noted in our discounted cash flow model, Lowe's is at a historical all-time high for their free cash flows, and this might not be sustainable going forward. So that's something that you really would want to understand before considering an investment in the company. That might be difficult to come to a conclusive understanding one way or the other, but it's absolutely critical before investing into Lowe's. So based on that discounted cash flow model, if Lowe's keeps increasing its free cash flows based on its 30-year historical records, then you could reasonably expect about a 13% compounded annual return over the next 30 years for Lowe's based on those assumptions. So you have to understand if those assumptions are correct. If we would cut that growth rate in half, Lowe's would return about an 8% compounded annual return over the next 30 years. So again, those are based on historical assumptions. It's probably likely that that's not going to be the case into the future. The only way to have any idea of whether those are applicable or not is to do further due diligence into the business. This type of analysis and that discounted cash flow model really serve as a starting point to learn whether it's worth your while to learn more about the business. This entire video is not financial advice. It's not a buy or sell recommendation of Lowe's, and it's very important that you talk to the right financial professional experts before considering any investment. So with that said, that's it for today's fundamental stock analysis of Lowe's Companies, Inc., ticker symbol LOW. If you enjoyed today's video, Please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Lowe's with me, and have a great day.